Fixed maturity plans are in the news for all the wrong reasons. What are those reasons? What are fixed maturity plans? We'll discuss in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Dhirendra, welcome to the show.
Thank you.
Burning question, but before that, a basic question. What are the fixed maturity plans?
They are debt funds, but unlike open-end fund where you can invest anytime and take your money anytime, these funds come with a term. They are almost like they are designed like a fixed deposit. It comes with a term. Investors invest, and they can't take their money out in between.
Okay.
They can take out only at maturity.
Okay. So the term is defined?
So the term is defined at the outset, okay. And normally, they are 3 years and more, because 3 years get you the tax efficiency. And the advantage of this is that when you invest in a fixed maturity plan, you get predictable return, because at that point all the money which the fund manager gets, he invests in a certain set of bonds, and it is a buy and hold portfolio. Okay. He holds it because he has a very clear premise that all the money that has come in, it is not needed before this date. And whatever value, because bond funds also go up and down in value, their values go up or down depending on the interest rate outlook or bad credit or view on credit changing, view on those bonds changing. Here it doesn't matter, because interest rate outlook, even if the view changes, even if the NAV goes down, doesn't matter, because the bonds will be held till maturity. So the character of a bond is that normally any bond has three things going for it. One is that that what is the residual term, what is the time period. You buy a bond today and it has expiry after 36 months or 4 years. So you know that, okay, this is when I will get my principal back. You know the coupon, that how much interest it will get me. Okay. So, and if it is poor quality, it gets you higher interest. If it is very high quality, it gets you lower interest. Okay. So you know the coupon, you know the interest, and you know what quality it is. So depending on that, and mostly these fixed maturity plans, they are a bunch of bonds. It's a portfolio of bonds. So you are able to diversify your risk. So even if something goes wrong, all of it will not go wrong. You are able to spread it over different quality, different, of course they all must have expiry or maturity of the underlying bonds coinciding with the expiry or the term of the fixed maturity plans. So if FMP is to expire in or has a term ending in December 2019, then all the bonds must, the fund manager should be able to realize it in December 2019. So you get predictable return, because at the time of investing, whatever happens to the value in the entry, it doesn't matter, because you are likely to get that return at the termination of the fund.
So the difference is that in fixed deposit, you have, say, a bank's fixed deposit.
In a bank fixed deposit, you put your money and you get the guaranteed return. In a mutual fund, you get the return depending on...
There are many bonds.
Yeah, all the combination of bonds, all the return that will be realized, all the interest that will accrue, you will get it at the end of the term. And generally, it has been higher than the comparable fixed deposit at that point, because that's the design of a mutual fund. All the return accruing to those bonds, less expenses is investors' return. Okay. So, and the difference between a FMP, fixed maturity plan, and an open-end fund is that because a lot of investors take their money out, or a lot of investors invest in between, the fund manager has to proactively manage it. Okay. And because now we have 16 kind of debt funds, so their stated objective drives fund manager to manage it actively. So many a times, you can't take a long-term view with a bond fund. In a fixed maturity plan, you know that, okay, today the current yield of a combination of bonds could be 9.5% or 8.5%. So you can be reasonably assured that if you put your money now and get it at the maturity, you will get that return less expenses.
Okay. So what are the reasons the fixed maturity plans are in news these days?
Oh, the problem is that these fixed maturity plans, they try to optimize return. So they invest a part of the money in very high quality bonds, maybe Government of India bond. Then they invest in reasonable quality corporate bonds, AAA bonds and AA bonds. And then they put in a small part of the money, or depending on their own judgment, they invest in lower rated bonds, and lower rated bonds to optimize return. And in some of the funds, many funds have exposure to certain securities which are not defaulting, but they are on the verge of defaulting. They are not honoring their commitment of giving the money back on time. They have sought, SL group companies borrowed money. Two of their group companies borrowed money, and they said that we will give you the money back, interest on time and capital back on time, and they are unable to do that. Additionally, those companies have, the promoters, they have given their ownership, their shares in Z Entertainment as collateral, and when it was due for, expiry or maturity, when they are supposed to honor it, they did not give the money back. When they did not give the money back on January 25th, the fund companies which were holding those Z Entertainment shares as collateral, they sold 200. They have borrowing of nearly 13,500 crore. They have actually pledged 13,500 crore worth of their Z Entertainment shares to mutual fund to borrow money for those two companies, or a few other companies too. 200 crore worth of shares were sold, and the stock fell by 30%. So mutual funds realize that if everybody starts selling the collateral, this is, when you borrow money, you give something as collateral, and by selling those collaterals, selling those shares, the value went down. So if everybody would have sold it, the stock price would have collapsed and everybody would have lost money. So they decided, mutual funds collectively decided that let's not sell it, let's go and try and get the money back from them, or renegotiate or talk to them. So the promoters have demanded some time, September 30th, and so now one has to wait. So every fund which has exposure to those bonds, like the Kotak fund which was due for maturity, it has been able to redeem 85% of the money, and 15% of the money, the two bonds exposure and one additional exposure, that was IRNFS transportation, which had trouble even before, that accounts for 15% of the units. That has been held back for resolution till September 30th. So investors have got their 85% of the money. They haven't effectively, translates into there has been no return for investors. They have virtually, they only got the capital back, but they haven't got any of the returns. And return is subject to, there is a probability that they will get their return. They will get their return by September 30th or before. Of course, fund companies have the right to sell those shares again in the market, because that collateral lies with them if they are unable to get the money back. So let's hope that investors get their return, but so far they have largely been able to get only their principal in that particular fund.
So how bad is this situation?
It is not all that bad. So far we have.
Is there anything to worry about?
No, there is something to worry about, that it is disappointing for investors. It is disappointing to investors because I have come across a lot of mails and a lot of people calling me. The real problem does not lie here. In fact, the real problem lies in the fact that many investors were sold these fixed maturity plans by some people who said that they are almost as safe as fixed deposit. They are just as good as fixed deposit. I think the lack of understanding that they also carry risk. Once in a while, you will not get a part of your money back. It may not necessarily yield the very high return which they were pointed to. But it's not all that bad, because when I look at all the FMPs, there are about 30 FMPs which has nominal or some meaningful exposure, ranging between 2 to 8 to 10%. So 2 to 8 to 10% of your money
to ILFS and
to these bonds, which means that there will be a reduction in your return. There will be a delay in the payment of that return subject to resolution. There is a possibility that you may not get all the possible return. But it is not that somebody's money has vaporized completely. It is not a debacle. It is not a catastrophe that you invested 5 lakh rupees and you are not getting any of your money back. In fact, most people who invested 5 lakh rupees in the FMP which has matured, and only 85% has been honored or has been returned, has been redeemed, they have got their principal back. The return is subject to resolution, which will require some more time.
September 30th.
By September 30th.
So investors as of now stand to lose in the sense what they have
Yes.
capital that they have put in, they'll get that back.
Maybe
to some
not.
extent.
To a reasonable extent.
Yeah.
I'm hopeful that most of these, because they have collateral, the promoter has gone on record to, and it is all subject to, the promoter has given a resolution plan that he's planning to sell his company, and if he gets the money, he will honor all his commitments. So I'm hopeful, and the collateral is of a quality which has some intrinsic worth. But yes, it is all messed up. It's not done till you get your money back. So it's a reasonable anxiety for investors. But at the same time, I would say that the likelihood it is fund companies have been able to go back and renegotiate that. If they are able to get the money back because of the delay, will they get some higher return? Yes, little bit more. Even this 6-month period for the residual money which is stuck, they will get higher return from the issuer of the bonds because it has been delayed. I would say that 95% of the FMPs redeemed in last 1 year, they have been able to they have been decent experience for investors. These FMPs, they come in large number. Every fund company launches it because one is expiring, so a fund company launches at the time of expiry so that investors who get their money back from one FMP, they remain a fixed income investor, they have nice experience, they have good experience, so they reinvest that money in the new FMPs. I would say that with 90%, 95% of the FMPs so far has been reasonably rewarding. I think the problem is naive investors who were told something else by some of the bankers who were selling these funds. That is something which has to be tightened.
Okay. We did receive a question from one of our viewers, Saurav, and he mentioned exactly what you said just now, that the FMP matured few days back, but what I have got out from the company is 90% due to some default, which you very nicely elucidated on the debt securities. So he's asking, what should I do?
Unfortunately,
should I wait just till September 30th now and take action after that? But he can't take. Can he take any action?
No, nothing can be done about it because this is the money which is stuck. It is subject to resolution. It is all happening in a legal framework which will take some time. It can happen early, but unfortunately there is nothing which an investor can do.
Okay. And then we had another viewer of our, Ayush, who said that I invested in some FMP which was due for maturity now, but the fund house has extended the tenure by approximately a year. So due to default, as we were discussing, now he's again asking us, what should I do?
I have to see that whether you get an interim exit opportunity. If you get an interim exit opportunity at current NAV, your realization will be lower, and it is happening exactly for the same reason. I would say that hold on if you don't need the money urgently, and if you have some urgent need, if you have some necessity that you must realize the money, then take the lower return and get the money now, because fund companies, when they extend it, they have to provide an interim exit, but it will be at lower value. So it will be a compromise on return. I would urge that if you can somehow, if the need is not very urgent, if you can do without getting the money now, postponing it for a year, I'm hopeful that most of the returns which looks like you have lost the return will be realizable.
But you also mentioned that there is a possibility that they would get extra interest.
Yes,
there is a possibility.
Because of the delay, and also 85-90% of the portfolio is at work. It is yielding return, it is yielding interest. It is the remaining 5-10% which is there, which is eating away all your return. I would say that next even extending it for 1 year, and if you are a fixed income investor, it is not an opportunity loss. It is not a compromise on return. Don't panic. Acting in a huff will be to your disadvantage. All you should do is assess your own requirement. If you don't need the money, go for the extension. If you need the money, then by all means take the money back. I don't think even if you get little less, it's fine because you're getting your money back. for the need, because how good is money if you don't get it when you need it. So I would say that next 1 year it should yield decent return, and even the problem which has to be resolved should get sorted out.
Will it be able to make good?
I hope so.
The losses?
I hope so, because it is not actually, it's understandable what's going on. It also brings in, and investors don't have a choice. That is the design of the product. One should not miss out, we normally take it very casually the way it is there, the statutory warning on a cigarette pack or about a mutual fund that they are subject to market risk. I think it just brings home the message that it's real. They are subject to market risk. You are carrying a risk, and the risk as and when it visits you. I have, there's only one problem with some funds where the exposure is pretty large. I would have expected that such large exposure to a single bond issuance should not be exceeding 5-7%, simply for the sake of, on the principle of prudence.
Okay. And what's the lesson for the investors in this? What should they learn, and perhaps is there a way to safeguard? I don't think.
No, there isn't a way to safeguard, but
but the lesson.
No, but there is a lesson. There is a way to safeguard that if you are a fixed income investor, even if you are investing in fixed maturity plans, don't look at, mostly investors look at the highest yielding FMP of a company and then invest in the new one. And when investing in fixed income, when investing in debt fund, no extra return comes without assuming greater risk. And risk doesn't visit you every day. But once in a while when it does, it hurts you. And these are the kind of situations which you land in. So avoid the best performing, highest yielding FMPs. Also, there is one kind of risk which can be mitigated, which is if you have 50 lakh rupees to invest, or 30 lakh rupees to invest, or 15 lakh to invest, don't invest in one FMP. Spread it in 2 or 3. Also, I have some very basic thing to say, that one investor can completely do without investing in an FMP. Because if you invest in a liquid fund or ultra short term bond fund, you are at liberty to take your money out anytime. You will not be stuck with kind of lack of liquidity.
There's no lock-in.
There is no lock-in. I don't think it is also a great compromise on return. Many of the funds are actually able to deliver you somewhat similar return in a region of 0.5% plus minus. At the same time, I would say that it's very important to choose a fund where your principal is not at stake for marginally high return. I don't find the payoff good enough. If you succeed with a great FMP, you might earn 1% more. But if that doesn't work out, but to earn that 1%, somebody will be assuming far greater risk. That may not be worthwhile.
Dhiren, what I need to ask you is, or rather what I hear from you is, stay away from FMPs. ऐसा मुझे लग रहा है.
Yes, largely because most of
because I'm just sorry for butting in. What you said about 1% के लिए इतना क्या ज़रूरत है?
That is one thing. That apart, I would say that largely most investors' needs are fulfilled by better product, open-end funds where you can walk in, get out anytime. They are well managed, and because I don't like lack of liquidity, it's a compromise. Okay. And your inability to get out, and it also brings in far greater accountability on the fund companies. They conduct differently when they are running open-end fund with far greater responsibility, because here they are able to assume such risks which may not be worthwhile. So I would say that FMPs will still be, they are able to strike a chord with a lot of fixed depositors, mutual fund companies, salespeople, or many distributors, banks. They are able to pitch these funds as something which is similar sounding, similar characters as a fixed deposit, and most of them have succeeded. They have delivered returns, and very much in line with reasonably satisfying, but experience for investors. But most thoughtful investors can do without having FMPs.
So will the DNA of mutual funds change because of the FMPs?
Yes, I would say that it's just not worthwhile for them to have this heartburn. They would not. One, they will be acting more prudently. The other is that they will, which means that they will not have a large allocation to something which can land into trouble. They will still be assuming risk, because the whole idea of investing in a mutual fund is to improve your return, and in a manner that the likelihood of that risk materializing or turning out to be very risky is not there. So they will be acting a little more prudently. There is also a possibility that many of these practices of collateral backed, promoter share backed collateral, because this is a fundamental issue. You have given a collateral, and the value of that collateral changes every day depending on the opening of the market and closing of the market. So the sanctity of that collateral is at question. So we have to see how it evolves, but so far it has been disappointing, but I don't think it is a calamity.
So as Dhirendra said, FMPs have been disappointing, but you need to hang in there and wait for September 30th to come, because things will change then. Taking leave of you, my name is Rajesh Lake, and along with Dhirendra, I say goodbye to you and keep investing.